this week's market update. Politics is in focus on both sides of the Atlantic as Theresa May's Brexit deal starts to unravel and Donald Trump visits the UK in the face of expected protests. Saudi Arabia warns of an impending oil supply crunch, China recalls memories of 2015, and US earnings season gets underway. Britain's extended nervous breakdown over Brexit took another twist this week after the cracks in Theresa May's cabinet re-emerged within a couple of days of Friday's confident declaration of collective responsibility. David Davis, the Brexit secretary, resigned on Sunday evening in protest at what Brexiteers consider to be a betrayal of the 2016 referendum and a slide towards a soft Brexit that will see Britain remain in a close embrace with the EU. His departure was soon followed by the resignation of Boris Johnson, the Foreign Secretary, a move which raised the possibility of a leadership challenge in the ruling Conservative Party and even another general election, as the government looks increasingly incapable of driving forward a Brexit deal that will be acceptable to either its own fractured party or the EU. Markets were relaxed about Davis's departure, with one strategist saying, "What matters for sterling is the type of Brexit delivered, not who delivers." The pound rose slightly against both the dollar and euro, while the FTSE 100 edged higher early on Monday. Even after Johnson departed, the market initially kept its nerve as investors bet on an economically more favourable outcome. Investors are broadly in favour of a softer exit that sees Britain remaining in some kind of customs arrangement with the rest of the EU and staying within the single market, at least in part. Whether that kind of Brexit can actually be delivered remains uncertain. It's not clear that Mrs May will still be in charge of the government beyond the summer. It's also unclear how far the EU will go towards accommodating Britain's desire to cherry-pick the bits of EU membership it wants while rejecting the parts it doesn't like. Meanwhile, the dangers of an unfavourable exit from Europe continue to mount, with both BlackRock and Citi announcing plans to expand in Paris rather than London. France has been actively courting financial services companies, seeing Brexit as an opportunity to knock London off its perch as the region's dominant financial centre. And the danger of going it alone has been further highlighted by the EU's agreement this week to go ahead with its biggest ever free trade deal with Japan. The agreement will do away with all but a handful of tariffs between the two sides, effectively linking around 600 million people and covering about a third of global trade. After 2 years of drift, the possibility of a no-deal exit and even of no exit at all have re-emerged. Many on both sides of the debate are asking what the point of Brexit might be if Britain's relationship with Europe looks exactly the same, except that we lose the power to influence the laws we're obliged to adhere to. The deal and the unravelling of it comes in the same week that Donald Trump fired the first shots in the escalating trade war between the US and China. Last Friday, the US president implemented 25% tariffs on $34 billion of imports from China, prompting an immediate retaliation from the Chinese. This looks like being just the first in a series of tit-for-tat tariff announcements that could, in due course, affect all the $500 billion or so of Chinese exports to the US and the $130 billion that goes in the other direction. And that's before other tariffs take effect on trade between the US and other so-called allies in Europe and Canada. All in all, up to $1 trillion of exports and imports could soon be affected by higher taxes, casting a shadow over the globalised trade that has underpinned growing prosperity the world over in recent decades. Increasing trade tensions have cast a shadow over stock markets so far this year, with the S&P 500, which has led the world's equity markets in recent years, standing just 2% higher for the year. Other major markets in Asia and Europe have failed even to remain in positive territory for the year to date. A key determinant of where markets go next will be the forthcoming earnings season for the second quarter, which kicks off this week with the bank results that typically pave the way for other sectors' announcements over the next few weeks. Having seen earnings rise by nearly 25% on average in the first quarter on the back of tax cuts, all eyes are on whether that turns out to be as good as it gets for American companies. Current forecasts are for a still impressive 21% rise year on year in the second quarter, as the US economy remains in good shape, with higher than expected job creation confirmed by last Friday's non-farm payroll data. That's certainly much stronger than on this side of the Atlantic, where European earnings are penciled in about 9% up on last year. Meanwhile, in Asia, investors' worries are less speculative than actual, as the main stock markets in Shanghai and Shenzhen look back on a dismal first half of 2018, in which shares have traced out the 20% decline that usually signifies a bear market. With the Chinese currency also under pressure as investors weigh up trade tensions, high debt levels and a property bubble, memories have been revived of the summer of 2015, when the Shanghai Composite fell by 45% amid widespread volatility and botched government intervention. The good news for investors in China is that the valuation of A shares in Shanghai are now below the trough reached in January 2016, prompting some market watchers to question whether this is now a buying opportunity. There's certainly no sign yet of the kind of capital flight that triggered the market turmoil 3 years ago. In other market news, the oil price remains in focus after the head of Saudi Arabia's state-owned energy giant Aramco warned that the world faces a supply crunch in future that could send the cost of crude sharply higher. He blamed the oil industry's focus on so-called short-cycle production like shale, which can be turned on and off much faster than the long-term mega projects that have traditionally made oil supply more predictable. Amin Nasser, the chief executive of Saudi Aramco, said that international energy majors were more concerned with cutting costs and returning money to shareholders than in the long-term investments that will be needed to meet rising demand for oil. His comments, which chime with similar cautionary remarks by the International Energy Agency, come as Aramco considers whether to seek a stock market listing amid doubts about whether the markets will give the company the $2 trillion valuation that Crown Prince Mohammed bin Salman is understood to be demanding. Saudi Arabia's oil production is also in focus after Donald Trump called on the kingdom to ramp up production in response to falling supplies from Iran, which faces US sanctions, and Venezuela. Which brings us back to where we started, with politics and the US president. Donald Trump's contempt for the rules-based system that has governed international relations since the Second World War is not restricted to trade. He also has little time for the collective defence provided by NATO, and he sought to undermine this week's meeting of the North Atlantic Defence Treaty members by tacking on a get-together with Russia's President Putin immediately afterwards. Trump is filling the gap between this week's NATO summit and his meeting with Putin in Helsinki next week with a controversial visit to the UK, at which he will endeavour to keep away from planned protests by spending almost no time in London. Rather, he'll dine with business leaders at Blenheim Palace, speak to the Queen in Windsor, and play golf at the course he built in Scotland. With so much uncertainty, it's perhaps unsurprising that markets are directionless this summer.